Hi, I'm Jimmy. In this video, we're looking at my personal investment portfolio. What are the individual companies that I have? What percentage of my portfolio do they each take up? What are my plans going forward for the entire portfolio? What companies have I added recently? And then ultimately, we're going to talk a little bit towards the end of the video about different ways we could each manage our individual portfolios, including how I'm managing mine. Now, before we jump into that, I just want to tell you real quick about a website that we have and our private investing community, just in case you want to come over and join it. I'll be real quick about it. So, real quick, the goal of the website is to try to make analyzing companies and valuing companies quicker and easier. So, real quick, just from a valuing standpoint, if you were to look at a company like, let's say, Johnson & Johnson, well, here, discounted cash flow is very logical for a large, well-established company like Johnson & Johnson. Here, we could see discounted cash flow. The stock's about fairly valued. But what if you wanted to look at a more unique company, maybe a utility? Maybe you're looking for something defensive in your portfolio. Well, when we jump over to this utility, discounted cash flow generally is not the best valuation method for a utility. Here, the website will warn you, this is not the best valuation method. We click on that. We jump over, we look at price to earnings, and we can see whether or not the stock looks to be under or overvalued based on its own historical averages. What about a bank? Banks are notoriously difficult to value. Well, if we put in a bank like Citigroup, I actually have this in my portfolio. We'll see that one in a second. When we put in a bank like Citigroup, well, there it tells us price to book value is a better valuation method than discounted cash flow. We click on that. We jump over to price to book value. And just like that, we can see that right now, Citigroup looks like it could be undervalued. Ultimately, where I want to go with this is that it doesn't just show you the one valuation method that's good, but it shows you, let's say, the top 3 best valuation methods. We continue to update this website to try to make it easy to value companies, hopefully use the best valuation method most appropriate for that industry, but also research companies, look at charts, analyze the numbers, things along those lines. We're trying to make it as simple as we can. So again, if you want to join us, we do 3 private live streams per week in our investing community. There is a link in the description below. Let me know if you have any questions. Okay, now with that being said, let's jump into my personal investment portfolio. So my largest holding is Meta. So I bought my shares of Meta at $172.19. Right now, it represents about 19% of my portfolio. When we compare that to today's price, well, the current price for Meta stock is a bit over $500 per share. That puts me up about 192%. So overall, this stock has been really, really good to me. But as you might be able to tell, this represents 19% of my portfolio. We're going to come back to that towards the end of this video to talk about how I could be one of the best ways that I'm trying to deal with it, but how we could all deal with the fact that our good stocks tend to take up a bigger percentage of our portfolio as time goes on, and what's the best way to deal with it. Okay, next, another relatively large holding for my investment portfolio is Microsoft. Right now, the current price for Microsoft is a bit under $450 per share, which puts my investment at just short of double my money, up 95%. So again, overall, this is probably a bit too big of a piece, but it's doing fairly well, so no complaints here. Okay, moving on to my next largest holding, and that is Google, or Alphabet, really. Google, Alphabet, I bought it about $118 per share, represents about 13% of my portfolio. Compared to the current price today, the stock's sitting at about $180 per share. So I'm up about 60% since I bought this stock. So again, doing fairly well for me. Okay, now we're jumping onto my most recent addition to this portfolio, and that is Ulta Beauty. Ulta Beauty represents about 7% of my portfolio, and I paid just under $400 per share. I did a video just recently on Ulta Beauty. I will leave a link to that video in the description below if you're curious why I bought it. By the way, for anybody who's new to the channel, I have this self-imposed rule that I won't buy a stock unless I first make a video about the stock, unless I do a deep dive on the stock. All the stocks in my portfolio I've done deep dives on. So I do a video on it. If I like it, I say, hey, I like it. And I'm going to jump in and buy this stock. But I try to wait a couple of days after I release the video, just so everybody gets a chance to do their own research and see if they like it. And yeah, I just think it's a good practice to have. So I bought this one a couple days after I released the Ulta video. I'll have that video in the description below if you're curious. Right now, Ulta Beauty is down to about $3.90 per share. So maybe if it keeps dropping, maybe I'll average down just a little bit. Usually I'm aiming in the 7, 8, 9% range from a portfolio. That's typically what I'll define as a full position, 7, 8, 9%. And this one's down a little bit, but it's only been a couple of days that I've been holding. Okay, next up, we've got Alibaba. Now, Alibaba is probably the most undervalued stock if you were to do any sort of analysis on Alibaba, but there's certainly a decent amount of risk. I bought this stock at an average entry price of about $99 per share. Right now, the stock is sitting at about $70, $75 per share, and I think I'm down about 23% or so. There's a little bit of risk in Alibaba. There's a lot of risk in Alibaba. Pretty much any Chinese company comes with a lot of risk, but it represents a relatively small amount of my portfolio. Or let's put it this way, I'm certainly happy with this amount of risk given the potential upside. And I'm willing to wait the time that it could take to likely see the upside. So this one's down a little bit, but I'm not overly worried about it. Okay, next up, we've got Apple. Apple represents about 7%. Again, it's about the same size as Alibaba. I bought my shares at about $139 per share, and currently the stock's sitting up at about $212 per share. So this stock has popped up about 50 or so percent. As you might guess, I'm fairly happy with my Apple stock at this point. Up 50%, not too bad. Okay, now we'll jump over to two longer-term value plays, and that is Disney and Intel. I get about 6.5%, 7% positions in both of them. Now, we can see that with Disney, the stock's to about $100 a share. I'm up a little bit. I'm up about 6%. And then Intel, it's down a little bit, down about 15%. Stock has fallen from about $37, $38 per share where I bought it. It's down about 15% to about $30 per share. Both of these are longer-term buy and holds. I plan on holding these for a long time. And I believe that I've done extensive videos on these recently, or at least on Intel. I'll do an update on Disney fairly soon. But I'm fairly confident over the long run that these companies have a potential to turn around and turn into pretty good investments for us. Okay, my next holding is Lockheed Martin. Now, I bought Lockheed Martin because, as you might be able to tell when looking at my portfolio, not a lot of defensive names. Lockheed is a fairly defensive name. It literally makes defensive, it's literally a defensive company. So I bought this one. I paid about $336 per share. Since then, the stock's jumped to about $450 per share. So I'm up a bit over 40%. Now, this is only about 5% of my portfolio, but I'm fairly happy with Lockheed Martin, and I'm glad to keep it there. I like having some defensive names to try to balance things out a bit. It's another reason why I like adding Ulta Beauty to my portfolio, because it's a decent stock. It's a decent company. It's got pretty good growth. It's got fairly good margins, but it's a retail company that I don't really have another stock like that in my portfolio. Okay, now we're moving right along to AT&T. AT&T, I bought at about $17.85. It's about 4% of my total portfolio. And when we compare that to the current price, well, the current price is about $17.64, and I am up about 12%. Now, I know what you're thinking. Jimmy, the current price is $17.64, and you bought it at $17.85. Dude, that's down. You're not up 12%. But here's the thing. All of the returns that I've been showing you are total returns with dividends reinvested into the stock. And when we jump over to the website here, well, we can see that clearly this company has paid a decent amount of dividends. Now, they did have a big drop in their dividends when they spun off their Warner Media division. We'll come back to that in a moment. But those dividends are being reinvested into my stock. So although the price looks like I'm actually down, it is in fact up when you consider the added returns from the dividends. So I think the important thing for us to keep in mind is that the dividends that we get paid from any company that we own, any company, reduces the stock price by that amount. So what you're seeing in the stock price is price movement, not dividend movement. It's not the dividend. So if it's a $10 stock and it pays $1 dividend, tomorrow it's a $9 stock. And interestingly, it's a $9 stock, and it won't show the stock is down when it opens the next day at $9.01. It'll show up 1 cent. So I've done videos on this in the past. If you're curious, leave a link to that video in the description below. But for now, AT&T's up a bit despite the fact that the price return for my investment is about flat, slightly down, as was rightfully pointed out. Okay, now we're jumping over to the Warner Brothers Discovery Company. This, I actually received my shares from my investment in AT&T. AT&T spun off Warner Brothers and Discovery. They combined Warner Brothers with Discovery to make Warner Brothers Discovery. I then did an analysis of Warner Brothers to see if it was something that I wanted to hold on to, or maybe even add to, or did I want to sell it? I ultimately decided to add a little bit to my Warner Brothers holding from what I got from AT&T. And my average entry price, when considering what I got from AT&T, what I paid for AT&T stock, as well as the added shares that I bought of Warner Brothers Discovery, was a bit over $14 per share. And it represents a relatively small 3% of my portfolio. Now, right now, Warner Brothers Discovery, the stock has fallen all the way down to $7.24. Now, I'm happy to sit there and hold Warner Brothers announce what their plan is. And I think that they have a legitimate shot. They own HBO. They have a legitimate shot to grow their business. Again, I'll be doing videos on this in the near future. But I am down 50%. Now, the good news is that it's just 3% of my total portfolio, so I'm not overly concerned about it. But 50% doesn't exactly look great on paper. Okay, next up, we've got a banking stock, and that is Citigroup. Mentioned this one before, but Citigroup, I bought at an average price of 45 and change per share. Right now, the stock's up to about $59 per share. Now, again, I've done videos on Citi in the past, and I'll update these videos in the near future. But basically, they went a long time period without any growth, and they've kind of rolled out a new growth plan, and it's a longer term play. But at the time I bought it, it seemed very undervalued using price to book. So it seemed like a good time to jump in and buy it. And so far, it's up 40%, so it's doing fairly well for me. Okay, now we're jumping over to another small position of mine, and that is CVS. Now, CVS actually owns Aetna, so they have both retail locations and an insurance company. It only represents about 2% of my portfolio, and I bought my shares at about $86 and change. Compare that to the current price of about $60 per share, and I'm down about 26%. So again, I'm glad it's just 2% of my total portfolio, but 26% down isn't that great. I really want to jump in and do another deep dive on this to see if perhaps it's worth, at just 2% of my portfolio, I could bump this up to a half position, which would, in my mind, for me, a half position is about 4% of, my entire portfolio. So I could really double the size of this, pull down my average price if it's something that's still worth it long term. So I got to update my research and ultimately get a video out to everybody. Okay, now we're on to my smallest holding. And this one was intended to kind of pair off with my Citigroup holding, a financial company, and that is PayPal. I paid $63.34 per share. It's just 2% of my portfolio. And right now, with the current price of about $60 per share, I'm down slightly since I bought my shares. So it's not too bad. Again, these are all long-term buy and holds. And I'm more than happy to just sit and wait for these companies to play out my long-term investment thesis. Now, if the long-term investment thesis were to change, then yes, ultimately, I would close out these positions, whether they're up or down. If the long-term investment thesis changes in a meaningful way, I would pull out of this. Now, you might ask, what do I do about the fact that my bigger positions here they're overweighted? Let's call a spade a spade. These companies have run up too much relative to traditional portfolio rules. And if I was a professional portfolio manager, I used to be a portfolio manager at a mutual fund company. And if this was my portfolio, I would have already sold off at least parts of Meta, Microsoft, and Google to try to bring down their average positions. In fact, I probably would have sold those off and added to some of the more undervalued stocks. But because because this is my own personal money and I'm doing it for my own long-term investments, I don't have to follow the same rules. I'm not worried about inflows or outflows of capital like you might be if you're a professional portfolio manager. And I don't have to sell any shares if I want to take a new position. When I jumped in and bought Ulta Beauty, I added cash. I've been adding cash to my portfolio so I can kind of control the flow of the money in the portfolio. Now, if this was let's say, a retirement account, I couldn't freely move money in and out then yes, I would be selling my bigger positions. I would be selling part of the winners and take that cash and then try to find more undervalued companies or perhaps add to some other undervalued companies. But because that's not how I'm doing it, I'm more than happy to just sit here and let the winners run. And hopefully in time, some of the losers in my portfolio can start to turn things around a little bit. Now, if you're curious how to do deep dives on companies, I actually did a video called 8 Steps to Analyze the Stock. And again, if you want to get access to the website that I shared with you earlier, I will leave a link to both of those in the description below. I'll link over here as well. Thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.